Hello there. Welcome to session 3 in this course on financial accounting. In this session, we'll be looking at how to make adjustment entries at the end of each reporting period. In the previous session, we looked at the entire accounting cycle. We just skipped this part on adjustment entries so that we can look at it in a bit more detail in a separate session. In this session, we'll start by looking at why adjustments are necessary and why they are made, okay? And then we'll look at the different types of adjustments, namely deferred or unearned revenue, accrued revenue, deferred or prepaid expenses, and accrued expenses. Finally, we'll look at these 4 categories using an example. Okay, to begin with, why make adjustments? Because cash may not be received or paid whenever revenue is earned or expenses are incurred, right? Okay, cash can sometimes be received before the revenue is earned, or it can be paid before expenses are incurred. This situation results in a deferred revenue or expense. Deferred means postponed, right? Okay, which means cash has been collected or paid earlier. Okay, revenues and expenses have been deferred. Cash can also be received when revenue is earned, and cash can also be paid when expenses are incurred. Okay, in this case, you don't need to make any adjustments because as and when revenues and expenses are recorded, okay, cash is being recorded at the same time. Cash can also be received after revenue is earned, or cash can also be paid after expenses are incurred. The word accrued means accumulated. So in this category, revenue or expenses are being accumulated and cash is paid or received later on. Okay, in the previous session, we looked at some of the principles that guide financial accounting. Okay, one such principle is the revenue recognition principle. Okay, according to this principle, we stated that revenues should be recorded when they are earned. So regardless of when cash is collected, revenues have to be recorded as and when they are earned. Sometimes revenues can be earned in multiple time periods, right? So at the end of each time period, you have to make sure that you record the revenues that have been earned in that particular time period. Another principle we saw earlier was the matching principle or the expenses matching principle. Expenses are recorded when they are incurred to generate revenue. So whatever expenses are incurred to generate revenue should be matched in that same time period along with the revenue. In the accounting cycle, one of the steps was to create the trial balance, right? Okay. Before you make any end of the period adjustments, the trial balance you have is called as an unadjusted trial balance. And then after you make the adjustments, the new trial balance you have is the final adjusted trial balance. Using that, you can go on to create your financial statements and then go ahead with the closing process. If you'd like to review the accounting cycle again, you can go back to my video on session 2, where I take you through the entire process of creating journal entries and then creating the trial balance and preparing financial statements and so on. Okay, now we'll look at the 4 types of adjustments you'll see in this session. Deferred or unearned revenue. In this case, revenue is deferred, which means cash is received before revenue is earned. Accrued revenue. In this case, cash is received after revenue is earned. Okay. Deferred or prepaid expense. In this case, cash is paid before the expenses are incurred. Okay. And finally, accrued expense. In this case, cash is paid after the expense is incurred. We look at it using a timeline where it's easier to understand. When cash is collected before revenue is earned, okay, this falls under the category of deferred revenue. Okay. When cash is collected after revenue is earned, this category is accrued revenue. I want to bring to your attention that even though revenue is earned across multiple periods or expenses are incurred across multiple periods, okay, you always make an adjustment at the end of each time period. By making an adjustment at the end of this time period, you can ensure that all the revenue that has been earned up until that point is being reflected in the financial statements of that particular time period. Everything else that would be earned later would be reflected in the financial statements of the following time period. So you always make adjustments at the end of each time period so you can correctly capture the revenue earned and the expenses incurred up until that point. Okay, now we'll look at the 4 categories in a bit more detail. Okay, we'll start with the first one, deferred or unearned revenue. Okay, as the title states, the revenue has been deferred or postponed, right? Okay, or it hasn't been earned yet. Okay, when the cash is being collected, the revenue hasn't been earned yet. But with time, you start earning your revenue. But if you earn your revenue across multiple time periods, okay, you would have to make an adjustment at the end of each time period to make sure that it captures the revenue that has been earned in that particular time period. Let's look at how to make journal entries in the case of unearned revenue. First, when cash is received at this point, okay, when you collect your cash, you would want to debit your cash account. Let's just stick to a standard amount of, let's say, $100. Okay, so cash would be debited by $100. Okay, because revenue hasn't been earned yet at this point when cash is being collected. Okay, you would credit your unearned revenue account, okay, by that $100. Okay, why is unearned revenue a liability account? Because cash has been collected in advance for a service that hasn't been provided. If it so happens that in the future you're not able to provide the service, you might have to return the cash which you had collected earlier. Okay, and hence unearned revenue is a liability. Then when the revenue is earned later on, okay, unearned revenue would be reversed, right? Whatever you credited, now you're going to debit unearned revenue account by $100, and then you would credit your revenue accounts by $100. So you're basically just reversing your unearned revenue entry, okay? And now you're transferring it to your revenue account. Eventually, by looking at them together, you would see that you have just debited your cash account and you credited your revenue account. So these are the standard journal entries you would make whenever you encounter deferred or unearned revenue. Okay. Next, we'll look at accrued revenue. Accrued means accumulated, right? In this case, revenue is being accumulated or earned with time, okay? But cash collection happens much later. But again, as in the previous case, if the revenue earned is spread across multiple time periods, you would have to make an adjustment that records the revenue earned in that particular time period, and whatever was earned later would be recorded in the following time period. Let's look at the journal entries for accrued revenue. First, when revenue is earned, you would credit your revenue account by $100, okay? Because cash for that revenue earned hasn't been collected yet, it would be recorded as a accounts receivable for $100, okay? So you would debit your accounts receivable account, okay, which is an asset because you would be able to collect this cash later on. So finally, when cash is received, you would obviously debit your cash account, okay? And by doing that, you should also reverse your accounts receivable because you don't have any more receivables, right? Okay. So you would credit your accounts receivable account by $100. So these are the standard journal entries you would be making in case of an accrued revenue. Okay. Next, we'll look at the two types of expenses adjustments. Okay. The first one is the deferred or prepaid expense. Okay. Cash is being paid before expenses are being incurred. Okay. Cash is paid in advance and hence they are referred to as prepaid expenses, right? And then the actual expense is incurred later. But as we've seen earlier, if this expense incurred is spread across multiple time periods, you will have to make an adjustment to capture the expense that has been incurred in this particular time period. So to be consistent with the other categories you've seen earlier, you would be making a journal entry at the end of each time period. Now let's see how to make the journal entries in this case. So when cash is paid in advance, you would credit your cash account, okay, and you would debit your prepaid expenses account. Prepaid expenses is an asset. Why is that? Because you're paying for something in advance and you will realize the benefit for this in the future. So because this brings you benefit in the future, this account is classified under assets, okay? And then later when you actually incur the expense, okay, you would debit your expense account to show that expenses have been incurred. And then you would credit your prepaid expense account in order to reverse the journal entry you made earlier. Okay, because now you've incurred that expense. Okay, it's no longer prepaid. So this is the standard journal entries you would make in the case of a deferred or prepaid expense. Okay, finally, the fourth category is accrued expenses, where expenses are incurred and cash is paid later. Similar to the previous cases, if the expenses incurred are spread across multiple time periods, you will have to make adjustments at the end of each time period. By making these adjustments at the end of each time period, you can make sure that you're following the revenue recognition principle and the expenses matching principle. Okay, now let's look at the journal entry for accrued expense. Okay, when expense is incurred, obviously you would debit your expense account. Okay, but because you still have to pay for these expenses, you would credit your accounts payable account. Accounts payable is a liability account because you're liable to pay this later on. Okay. And finally, when you pay cash, you would reverse this accounts payable because you no longer have a payable. Okay. So you would debit your accounts payable account and you would credit your cash account. So these are the standard journal entries you would be making in the case of an accrued expense. Okay. So we've looked at the four types of adjustments so far separately. So the best way to make sure that you understand clearly and you remember these journal entries going forward is by putting them side by side and doing a comparison analysis. First, let's just focus on revenues. Okay, I've categorized them based on when cash is received. Okay, cash can either be received in advance, or cash can be received on time when revenue is earned, or cash can be received later after revenue has been earned. Okay, if cash is received on time, okay, you would debit your cash account and you would credit your revenue account. Okay, that's quite simple, right? Okay, if cash is received in advance, we know that it falls under the deferred revenue category. When cash is collected, the cash account is debited and you would credit an unearned revenue account, which is a liability. Okay, and later when revenue is actually earned, you would reverse the unearned revenue account, or you would debit that liability, and then you would credit your revenue account. Okay, we've seen this example earlier. Okay, when cash is received later, we saw that it falls under the accrued revenue account. Okay, so you would debit your accounts receivable account to show that you would collect this money later. Okay, and you would credit your revenue account. This is the journal entry you make when the revenue has been earned. Okay, later when cash is collected, okay, you would debit your cash account and you would reverse your accounts receivable to show that you don't have a receivable anymore. Okay, so you would credit that account. The advantage of putting these three cases side by side is that it helps you visualize these journal entries. So eventually, when revenue has been earned and cash has been collected, you can see that the journal entries made are not that different, right? Okay, here unearned revenue has been credited in the first step when cash is collected, and it's being debited in the next step. Okay, so that cancels out. So overall, you have a cash account that's being debited and you have a revenue account that's being credited. That's the journal entry you make when cash is received on time, right? Cash is being debited and revenue is being credited. Okay, under accrued revenue, okay, accounts receivable was debited in the first step, okay, and later when cash was collected, it was reversed, right? So that account is being cancelled out. Okay, you can see that cash is debited and revenue is credited. Again, it's consistent with what we saw in the previous two cases. So the only difference comes with the timing of when revenue is earned, right? If revenue is earned across multiple time periods, you will have to ensure that you make these adjustments. Looking at the expenses again from the same cash timing perspective, okay, if cash is paid on time, okay, you would debit an expense account and you would credit a cash account. But if cash is paid in advance, as in the deferred expense case, okay, when cash is paid, you would credit your cash account, okay, and you would debit a prepaid expense account, which is an asset. Okay, and later when you actually incur that expense, okay, you would debit the expense account and you would reverse the prepaid expense by crediting it. We can see that the prepaid expense account was debited in the first step and is credited in the second step. So by removing them, we can see that the final journal entry, which is debiting expense account and crediting cash account, it's very similar to the scenario as if cash was paid on time. If you look at the scenario where cash is paid later under the accrued expense category, okay, when expense is incurred, you debit the expense account and you credit the accounts payable account. And later when cash is paid, you would reverse the accounts payable, or you would remove it because you no longer have a payable, okay, and then you would credit your cash account, okay, because you're paying cash. Again, we see that the accounts payable account, which was credited in the previous step, was reversed by debiting it. Okay, so by removing them, we can see that the overall journal entry is again the same as before, which is debiting an expense account and crediting a cash account. It's even easier to remember if you look at the revenue and expenses categories put together. Visualize it like this. Okay, let's say there are two firms, firm A and firm B. Firm A provides services to firm B. Okay, so firm A earns revenues. Okay, so the journal entries for firm A are at the top, and firm B, which receives these services from firm A, okay, their expenses are shown in the bottom. So if when firm A provided the service to firm B and if firm B paid the cash on time, then firm A's journal entries would be debiting a cash account and crediting a revenue account. And firm B's journal entry would be debiting an expense account and crediting a cash account. Now let's consider a scenario where firm B pays cash in advance to firm A for a service they would provide later. Okay, then firm A in their books would show a debit to a cash account, okay, showing that cash has been collected, and then they would credit their unearned revenue account to show that cash has been collected but revenue hasn't been earned yet. On the other side, moving on to firm B, okay, they would show a debit to their prepaid expense account showing that they've paid in advance, and there would be a credit to their cash account. Later, when firm A actually provides the service, okay, they would reverse their unearned revenue account, okay, and they would credit the revenue, okay. And for firm B, okay, they would debit their expense account and they would credit their prepaid expense account by reversing it. So as we've seen earlier, the unearned revenue journal entry is just being reversed in the next step. So by removing them, it helps to visualize that regardless of whichever scenarios, when cash is collected in advance or on time or later, okay, the overall journal entries should always match. It has to show that cash has been collected and revenue has been earned. Okay, cash has been collected and revenue has been earned. For firm B, when they've received the service, okay, they would debit their expense account to show that expenses have been incurred, and they would credit their prepaid expense account to reverse what was debited earlier. Moving on to a scenario where firm A would provide services to firm B and firm B would pay cash for this later, okay. When the service is being provided, firm A would record an accounts receivable, okay. They would debit their accounts receivable to show that cash would be collected later, and they would credit their revenue account. On the other hand, firm B would debit their expense account to show that expenses have indeed been incurred, okay, and they would credit their accounts payable account to show that they still owe money to firm A. Later, when cash is being paid, firm A would debit cash account and they would reverse their accounts receivable by crediting it to show that it's no longer a receivable. Firm B would reverse their accounts payable by debiting it, okay, and they would credit their cash account. This is the benefit of looking at it together, right? Firm A first debits its receivable and then credits it, okay. Firm B first credits its payable and then debits it to reverse it. So if we try to hide all these journal entries and their reversals, okay, we can see that the final journal entries are always the same regardless of when cash is paid. Overall for firm A, okay, all that you're doing is debiting a cash account and crediting a revenue account. And for firm B, you're debiting an expense account, okay, and you're crediting a cash account. Visualizing everything like this together ensures that you don't make any mistakes during your journal entries. And it also helps you in a way that you don't have to memorize anything. After you make a lot of these adjustment entries and you see that the final result is not what you expected, okay, then it's easier for you to go back and debug. So my recommendation would be this, that when you study these 4 categories of adjustments, that you always look at them together, you look at their journal entries together, you put them side by side and you start comparing them. By comparing them, you can actually see that they're very, very, very similar. Okay, now let's look at an example where we'll have to show the relevant adjustments at the end of the fiscal year, which is as of December 31. Let's look at transaction A. On the 1st of July, Joe agreed to provide consulting services to client A for a fixed fee of $9,000 for a total period of 9 months, okay, which is $1,000 per month. The client pays the entire fee in advance on the same day. Okay, let's look at what's happening on the 1st of July. Okay, Joe agreed to provide consulting services to the client. Okay, the client pays the entire fee in advance on the same day. Okay, so Joe is actually receiving cash of $9,000 from the client. Okay, so the cash account is being debited. Okay, but the revenue hasn't been earned yet. Okay, the revenue would be earned over the next 9 months. Okay, so there is an unearned revenue of $9,000. Okay, so that revenue has not been earned yet and hence it's a liability. Why is it a liability? Because if it so happens that Joe is not able to provide these services later on, he might have to return this cash. Okay, let's see if there is an adjustment entry to be made on the 31st of December. Okay, so from the 1st of July to the 31st of December, 6 months have passed. So Joe would have provided consulting services for 6 months as of December 31. So he would have earned 6 months of revenue. So he would credit a consulting revenue account, okay, to show that $6,000, okay, and $6,000 out of the unearned revenue should be reversed, okay. 6,000 out of the 9,000 is not unearned anymore, okay. So Joe has earned 6,000, only 3,000 remains unearned, okay. So by debiting unearned revenue account by $6,000, okay, Joe can show that he has earned $6,000 out of that $9,000. And then in the next time period, Joe would earn the remaining $3,000 by providing his consulting services, right? The journal entry for that would be made in the next time period, okay? You would reverse the remaining $3,000 of the unearned revenue and you would book it as consulting revenue for that time period. Moving on to transaction B, on the 1st of September, Joe takes on a project for client B for a fee of $500 per month. Okay, the project lasts a total of 6 months. The client agrees to pay in full upon completion of the project. Okay, so the 1st of September, Joe takes on a project, okay, which will pay him $500 per month, but he will only get paid at the end of the project. Okay, let's see if there are journal entries on the 1st of September. As of the 1st of September, no cash has exchanged hands and no work has been done. Okay, on the 1st of September, there will not be any journal entries made. Okay, let's see if there's an adjustment that has to be made on the 31st of December. As of the 31st of December, Joe would have worked on the project for 4 months, okay, September, October, November, and December, okay, and for these 4 months, he would have earned a revenue of 500 times 4, $2,000, okay. On the 31st of December, he would credit his revenue account and show that a revenue of $2,000 has been earned. But cash has not been collected yet, okay. So he would debit his accounts receivable account to show that he will be paid later, okay, but he would show only the $2,000 that will be collected. So upon completion of the project at the end of February next year, okay, Joe would receive payment of 500 times 6, okay, he would get cash for $3,000, okay. He would book the remaining revenue for January and February, okay. So he would book a revenue of $1,000. He would say cash has been debited $3,000 because he's collecting cash, and he would reverse the accounts receivable, which is shown on the 31st of December. Okay, this accounts receivable will not exist at the end of February when cash is actually being collected. Moving on to transaction C, on the 1st of October, Joe paid $2,400 for insurance for 2 years. Okay, the insurance will go into effect on the same day. Okay, Joe is paying $2,400 for 2 years of worth of insurance. Okay, so that's 24 months. So that amounts to $100 per month. Okay. On the 1st of October, because he's paying $2,400, you would credit his cash account, okay, by $2,400. Okay. Insurance has not been used yet. Because he's paying in advance, he would debit his prepaid insurance account to show that he has paid in advance $2,400. As of the 31st of December, 3 months have passed. Okay, so Joe would have used up 3 months of that insurance. Okay, 100 times 3, $300. So he would incur an insurance expense of $300. Okay, so he has used up $300 out of that $2,400 of insurance. And he would reverse his prepaid insurance for the same amount. Okay, so he would credit his prepaid insurance account by $300. Moving on to transaction D, on the 1st of December, Joe contracts a local maintenance firm to carry out maintenance of the office premises for a period of 4 months for $200 per month. Joe was able to negotiate a deal where payment will be made on March 31st the following year. So December 1st to March 31st the next year, that's 4 months. Okay. So Joe contracts this firm for 4 months and he would pay them at the end of those 4 months. So on the 1st of December, no cash has exchanged hands and the maintenance firm hasn't done any work. Okay, so there are no journal entries on the 1st of December. But as of the 31st of December, the maintenance firm has already worked for 1 month. Okay, so they've earned that $200. Okay, so Joe incurs an expense of $200 by the end of December. Okay, so Joe would debit a maintenance expense account for $200. Okay, but because he still hasn't paid any money yet, so he would credit his accounts payable account by $200 to show that as of the 31st of December, he owes this firm $200. But he will be making his payment on the 31st of March once the maintenance firm has completed all 4 months of work. Okay, so in this session, we've seen the 4 categories of adjustments, which is deferred or accrued revenues and deferred or accrued expenses. Okay. In some of the future sessions, we'll look at more practical scenarios of these adjustments. For example, in part 4, we'll look at how to make an adjustment for an allowance for bad debt. And in part 6, we'll look at making adjustments for depreciation and amortization expenses. Okay. And in part 7, when you take a loan, we'll look at how to make an adjustment for accrued interest. In the next session, we'll be looking at how to account for revenues and receivables in a lot more detail. Thank you for watching. Cheers.